Good morning. It's glorious Wednesday, sunny, April 23rd. Zach Howard. Here's a 3-minute morning market update. We did have that turnaround Tuesday yesterday in markets, assisted by President Pump. Out there, he's going to walk back the tariffs with China, wants to play nice, all that, whatever you want to be. Scott Bessett, pre-official announcement, floated out to some special inside people that got the market going earlier in the day. You see that volatility and that VIX popping back here below 28. What does that do? It puts a bid into those risk assets, the S&P, lower VIX, higher S&P futures. Look at that, up 2.5% before we start today. So we do have a lower low in that volatility reading. Why did markets go up? Because they went down. There's all kinds of financial narratives always thrown out hourly, daily, through legacy financial media, CNBC, what have you, Bubble Vision. But sometimes it's as simple as that. Markets bounce because they went down so much. Case in point, my favorite company to follow, the most entertaining company in history, the car company, reported yesterday horrible earnings from an actual math data standpoint. But going into earnings, the company was down 50%. If you had bought at the cycle peak, when the narrative around we're all going to Mars and we're going to cure everything that ever exists because of St. Elon, you need 100% from where the stock closed yesterday just to get back to even. If you follow out the narratives of Sir Elon, the reality is the company's capital expenditures are down 46% year over year. Something growth company. I don't know. They still make cars the last time I checked, and the car revenue continues to fall big time. Auto sales down 20%, and operating income, the thing that actually matters if you're a shareholder, down 66%. But who knows? We'll just keep spinning the narrative as next quarter, next year, like it's been for the last 5 to 10 years. Eventually, maybe reality catches up to that. Uh, but really, like a lot of this stuff is exit liquidity. You had a chance to get out the last couple of times. It's going to bounce again here now in the next couple of days. That's what bear markets do. They bounce. But did anything change about the economic reality of slowing growth, slowing sales? That was just like the phase one of the cycle that we're in. Like, people can kind of spin it all they want, but we had a rate of change slowdown and it continues to slow down. And that's what I'm looking at here in Europe. Look at these PMI numbers coming out of Europe. Anyone new to what a PMI is, Purchasers Managers Index, anything below 50 is considered recessionary or contracting. Anything above 50 would be expansion. But look at the rate of change. That's what really I look at, the previous versus the actual. 50 to 49 in Germany, arguably the biggest manufacturing country over there, slowing growth, slowing growth. Look at it, services industry all across the board, particularly in the UK, a big slowdown in its S&P global composite PMIs. Uh, it kind of lines up with what oil and some other commodities are already saying. Continue to be a bullish trend. Oil's bouncing. The US dollar stopped going down, so that's putting a bid into some of those risk assets as well. Keep an eye still on that US 30-year. It's pulled back in its yield, but still has a higher range in that 30-year bond yield. I'm probably going to add the PFIX ETF to play a continuing rising longer duration yields in the US. Bitcoin breaking out bullish trend like that. Gold pullback as I was expecting, as it just went too fast too soon. But like today is probably a day to do nothing, just take it all in, because I think there's so many narratives out there. It's just forest from the trees. Have a great day. I will see you tomorrow.